Hello everybody, today I'm going to discuss the current trends in the market that I'm seeing going on right now, as well as why I think that this melt-up that David Hunter's been talking about for a while is still, very much at play. It still could very well happen in the coming few months, as David Hunter is still, um, saying very heavily on Twitter. He's saying that this is definitely not over, even though it hasn't happened as quickly as he might have anticipated. So today I'm going to go through just investor psychology as well as market sentiment and how these can just change so rapidly. So stay tuned. Hi everybody, welcome back to the Contrarian. My name's Logan. I really like to talk about overall success in investing as well as going against crowd thinking mentality, as the name of my channel implies. I like to question common narratives out there that I think aren't really based on sound thinking, and I do it with reasoning. I don't just go against positions just because I want to. It's just because I see them as being based on false assumptions. So the current trend in the market that we see right now is just a consolidation of the markets essentially right now, and they've been roughly in this range for the last 3 months. And when I say the markets, I'm referring to these index funds, so the stock market as a whole. But also this can be seen, with real estate, with other equity markets, but it's most prevalent just in the stock market, as well as some precious metals right now. We're just seeing a lot of consolidation, and a lot of people out there right now are very bearish. They're saying that this could, be a bad sign, that the markets could break a lot lower. And while reasoning might say that just because the overall economy is not doing well, I think that the stock market's rally is far from over right now. It actually could go much, much higher, as David Hunter has been saying for quite a while now. And he's been saying this since the beginning of last year, actually, before COVID. He was saying that this kind of late secular bull market, as he calls it, is going to essentially end in a parabolic melt-up that could pass 4,500 on the S&P 500, and that's still a ways off right now. That's 20% or so off right now. But the reason why this isn't such a big, why this isn't a completely uncalled for claim is just how quickly investor sentiment and the market sentiment can change. And if there's anything that COVID has shown us, it's that market sentiment can change extremely quickly. So we saw back in late February and early March, the stock market crashed. Many people don't seem to realize this, but it was an extremely bullish market, early February, January through early February of last year. And then all of a sudden, we start getting this news of this new virus and of it spreading rapidly around the world. And almost immediately, investor sentiment changes from very bullish to very bearish, and that only took a matter of weeks to happen. So basically what I'm saying is that we've seen that happen with the virus earlier this year. We've seen it happen with other things in the past, going from bullish to very bearish, and it also can go the other way. It can go from extremely negative sentiment to extremely positive sentiment very quickly as well. And this was one of the reasons that the crash was stopped actually back in the spring, was just the Fed's intervention and the assurance essentially they were giving to investors as a whole that yes, we're going to back up bonds, we're going to back up equity markets, we're going to essentially buy as much as we need to. Whether or not that's true, in reality there was no way they could have bought everything. But them saying that essentially gave investors the insurance that they wanted, the assurance or insurance, whichever one you want to call it, that they would be backed up. And so investors actually piled back into the markets and, helped them to recover, and actually recover very rapidly from the lows that we experienced last March, or late last March. So what I'm trying to say here is that just in the current environment that we're in, where social media, where the news, where media is always going to one extreme or the other, this melt-up that David Hunter's talking about and that he's talked about for a while is, it definitely can happen, much more quickly than people think. we could go from where we are now in the S&P 500 around 3,700. We could go from here past 4,000, well over 4,000 very quickly. And these kinds of moves have happened earlier this year, just earlier this year. This is not going back to some, decades ago experience. This is a very recent thing that's happened. So, something like the vaccine being deployed, something like encouraging, news regarding the economy, regarding businesses, regarding unemployment, any of these things could, rapidly change investor sentiment and could send the markets skyrocketing as a result. Now, my main precaution with this, and obviously none of this is to be taken as financial advice, but my main precaution with this is that such a move is not sustainable. And as David Hunter puts it, this would be the end of a, 34-year plus secular bull market. So that's essentially saying that, interest rates in the early 80s, late 70s, interest rates were in double digits, were nearly 20%. And that, over the last 35 years, they've gone from nearly 20% down to basically 0%. So in saying a secular bull market, he's saying that because interest rates have dropped so dramatically, this has given, equity markets, but mainly the stock market, such a long runway to go so high. And my main precaution with this whole melt-up thing is just don't be caught into it, because, the ending of this secular bull market, is going to give way to a long bear market likely, where interest rates will need to rise eventually. I know the Fed is not saying that they would rise, but that is what will happen as a result of inflation rising very rapidly as a result of all the stimulus they've done. So essentially, it's kind of like a domino effect. They did the stimulus in the spring. Inflation has not happened yet as a result of that, but it will happen as a result of all the stimulus that they've done and, more stimulus that they're planning on doing. That will cause inflation eventually, and then the rising inflation will have to be controlled by a rise in interest rates. So basically what I want you to take away from this is that don't get caught up in the crowd thinking of investors right now, whether that be, extreme bearishness, extreme negativity, or extreme bullishness, should the melt-up happen, which I'm saying is probably likely that it happens. Just don't get caught up in the investor mentality out there, because either way you're going to lose. So, if you like these kinds of topics, just consider subscribing. I really like to talk about all of these, common narratives I see out there that I don't think are based on solid fundamental thinking, or what, even, a basic investing knowledge would lead you to think. They're just not really based on very sound thinking out there. So if you like these kinds of topics, just consider subscribing, and I hope to see you again.